I do believe that the stock market, has been discounting this for a good part of this year. The market is in a bear market. So the equity market's not going to be surprised, and even the fixed income market's not going to be surprised. The yield curve, so the difference between the 2-year and the 10-year Treasury yield, is over 80 basis points, 0.8%. This has not happened since the 80s, the early 80s, when Chairman Volcker, was taking a sledgehammer to inflation, an inflation problem that had built up over 15 years. This inflation problem built up over 15 months. And instead of increasing interest rates twofold, 10 to 20%, which is what Volcker did, Chairman Powell has taken interest rates up 16-fold. Again, never seen that before. And I do believe that the surprises now are going to be on the low side of inflation expectations, dramatically so. We believe that inflation will drop below the Fed's 2% inflation rate sometime next year. And the pipeline is telling us that. Commodity prices, inventories, which are overwhelming and causing all kinds of discounts. And the bond market itself, whenever there's a yield curve inverted, it is saying, okay, growth is going to disappoint, or inflation is going to be lower than expected, or both. Very surprised if we see anything like that. I think one of the most visible commodity prices out there, oil, despite a lot of potential support, can't get going. It peaked at $130 per barrel after Russia invaded Ukraine. It's now down to $74. And even with China opening up, we think, supposedly a support for oil prices, it can't rally. So I see you're putting up here 71.60, but that would be yet another proof point. So formed in the last year or so. We've seen the beneficiaries of inflation outperform. Now, I just told you that oil prices have come down from $130 to the low $70 range, almost cut in half. And yet the XLE, the S&P energy sector index, is not that far from all-time highs. So there's a bit of a disconnect there. And there we go. There we go. So what you will see as inflation unravels, interest rates come down, raising the present value of future cash flows. That kind of environment benefits our portfolio. We have stocks in our portfolio, companies that are going to be extremely profitable in the next 5 years. Right now, they may not be that profitable because they're investing aggressively to capitalize on some amazing opportunities in the genomic space, robotics, energy storage, artificial intelligence, blockchain technology. They're investing now because many of these are going to be winner take most markets. So they're huge markets. And therefore, there's latent profitability. The gross margins in our portfolio, so just taking a cost of goods sold from revenues, the gross margins are very high. And what they're spending on R&D, sales and marketing, stock-based compensation to attract talent in these early days is really important to their future success. So as interest rates come down, the present value of future cash flows going out 5 years, the present value of those increases toward, hey, maybe we're not going up after 4.5%, or a change in rhetoric will get the market going. The market is trying to figure out how high is high. And you've got some observers, economists out there thinking it could be 6 or 7%. And so the market is holding back and saying, wait, we need some evidence. Now, I think the evidence is becoming very strong because long bond yields are down at 3.5%. The long bond market does not think interest rates are going to 5 or 6%. It's been moving in the opposite direction. We got up to 4.25% on the 10-year Treasury. and now we're down to 3.5%. So the bond market, I think, is speaking pretty loudly, and the bond market itself, which would be the most sensitive to rates going up, is moving in the other direction. This is worse than 08, 09. And I think many technicians basically took a chart of the tech and telecom bubble and the bust, and they said, okay, that's what's going to happen. That has happened to us and more. This is worse than the tech and telecom bust. The difference between the two periods is we've got into an irrational market in the late 90s. Investors were piling on technology stocks, actually trying to outcompete indexes and each other. So they ended up with 40% technology, but the technologies were not ready. We didn't get cloud until 06. We didn't get breakthroughs in deep learning until 2012. Not only were the technologies not ready, the costs were way too high. To sequence the first whole human genome, it took $2.7 billion for one person's genome in 2003. Today, that's 500. The technologies are ready. The costs are low enough. The seeds for what we're investing now were planted during the 20 years that ended in the tech and telecom bubble. That was irrational. And I think we're on the flip side of the bubble right now. I think what's going on right now is irrational. Many of our stocks are below where they were at the low point in 2020 when COVID hit. Some of them are back to 2017 levels. And a company like Teladoc, its revenues are up 14-fold since. Its gross margins are in the high 60s, we think moving into the 70s. And that compares to the NASDAQ's 43% gross margins. See what I mean about latent profitability? They have a lot more to spend to make this backbone of the healthcare company. Its ultimate profitability is going to be superior because we believe it will become the healthcare information backbone of the United States, if not elsewhere. So just think about that. High 60s, low 70s gross margins compared to the NASDAQ, 43%. And yet the stock is selling for, I believe it's around 2 times revenues, whereas the NASDAQ is selling at 3.25. This is as irrational on the downside as the upside was in the late 90s. And the reason this has happened is because of the tech and telecom bust, and even more so, the 08-09 meltdown. Investors are scared to veer much away from their benchmarks. When we get into a risk-off period, they are selling any stock that's not in their benchmarks.
Well, I mean, in some cases, they're scared.
Finish this thought so that you understand and so that your viewers understand. So they have been selling our stocks because they're not in the benchmarks. And it has reached an incredible level. But I also think if you ask where the risk is now in the market, I think it's in the benchmarks that everyone's crowded into because they're very backwards looking, and our portfolios are forward looking. Most people will not construct portfolios the way we do. They need their benchmarks. We need the best companies who are going to execute on the future of these 5 new platforms. And we believe those are in our portfolio. So if no other reason, given the down round we've been through, if for no other reason, we would be a great diversifier for those who are hewing to benchmarks where we think there's a lot of risk to the traditional world order because of innovation.